All right, this is being recorded. One thing I say at the beginning of every webinar is watch this again. The reason why I say watch it again is because the first time through, some of the nuances of this strategy may just go right by you. You could be thinking about a question or something else along those lines and miss some of it. So watch it again so you catch those. And the other thing is if you watch it really soon afterwards, you're going to remember this longer. It's just a product of learning, right? If you study something and then review it afterwards, you will remember that longer and understand it better. So that's why I suggest that. All right, let me get a couple things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, and Wall Street Journal. They used to call me the Wolfman. And I used to talk about everything from economic to geopolitical and market analysis. And started trading in college with some money I'd earned, moved to Chicago, and in that time I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. How you doing, Banu in the house? All right. And then we also have to go over this. Basically, it says anything I say in this webinar should not be construed or constitute investment advice or solicitation to buy or sell any of these securities or strategies. I might even be talking about underlyings, you guys, that are in my portfolio. And when I'm doing that, it's because that's what's in my portfolio. And I might be giving directional assumptions. Well, because those are my assumptions. I'm not trying to make those assumptions yours. And some of the things I could be talking about are absolutely opposite of what you guys are thinking. So you might be thinking a stock's bullish and I'm thinking it's bearish. So take what you know and implement it into your portfolio in your own way. And remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right. Also, follow me on at Wolfman's blog on Twitter, and you can follow our parent company at ProTraderStrat for all kinds of market wisdom and stuff like that. And then this is going to be on the short strangle, but something I've mentioned at the beginning of several of these other webinars, because what we're trying to do is we are coming up with an assumption, or we have a bias, right, of a direction, whether we think it's going to go up, down, or sideways, right? So right now, what we're trying to do is come up with X, Y, Z's market direction. And all of a sudden I come up with something that is market neutral, or I believe it's going to stay within this range here, kind of thing. At this point, we don't really know we're going to be doing the short strangle. So I want you to think about it from a bias point of view, because that's usually the first thing we come up with when we're trying to come up with a directional assumption, right? I'm looking at the charts. I may not even know what X, Y, Z is, but I come up with, okay, this stock looks like it's going to trend sideways, and find out it's X, Y, Z. Now I start narrowing it down to find out what strategy is most appropriate for everything going on around XYZ, and that fits my market assumption. So with short strangles, we want a market neutral assumption, all right? So like I said, we don't think it's going to go up. No, it's not going up. Is it going down? No, we don't think it's going down. We think it's going to go sideways. We think it's going to trend sideways. Yes, it may go up and down like this, but we think it's going to stay within like a certain range is what I'm really coming up with. And that's where the market neutral comes from. And again, we don't know if we're doing the strangle yet. We just know we have a market neutral assumption. We're going to get to that. But, you know, I want you to kind of think about it in terms of us building this out as we've come up with the assumption in a sense. But we're just selling an at the money call and an at the money put, that's for the straddle. We're doing an out of the money call and an out of the money put, and we're going to be looking for the 16 delta on this. All right. So that's just going to give you the hint as to how we kind of build this out. We're going to be easily looking straight for that 16 delta. But like I said, we don't know that we're necessarily doing the short strangle yet, but we've got an assumption with XYZ, right? So we have this XYZ assumption. We think it's going to be trading sideways or kind of within that particular range. So when we are picking the right underlying, for XYZ, what we need to really do is go into the option montage and figure out if it is appropriate. So this is the option montage page where you have all the options and stuff like that. Some of yours might be opened up where you show all the strikes and all the pricing along the lines. Since I got GDX up, it's basically an ETF for the big gold miners, if you will. So what I want to do is take GDX and I look for the month that is closest to the expiration, but it's the one really that we used to call on the floor. It's the spot month. It's the one that really has the most volume and open interest in it. And what we want to do is look at the bid offer right here, just out of the money, closest to 35 days to expiration. So 35 days to expiration is usually where markets are trading the most. And this is closest to the 35 days to expiration at this point. You know, you could go further out. It takes a little bit longer. You're going to get a little bit more credit. You'll be able to get a little bit further away, but you're not going to get that theta decay right away. It's going to take about 10, 15 days to get like theta ramped up to where we're losing some several pennies a day. And that's what we want. We want to start losing money, right? Because theta is the thief in the night. And when you're selling premium, you want that thief to come and steal your premium. So, but picking the right underlying, we look at XYZ. And we look at the option montage down here, and any stock that is under, if it's less than $50, or sorry, Eric, if it's less than $100, I'm looking at this stock, seeing that it's a $20. I don't know where I came up with 50. If it's less than $100 stock, then what we're going to do is it needs to be about 10 cents wide to the bid ask, okay? And we've got the bid ask inside of 10 cents wide for that, so that fits the rule. Now, any stock that's over $100, we'll look at GLD, which is the ETF for gold, and we need to do something just a little bit different, but we just move the decimal place 3 ticks to the left, and we come up with 13 cents on this, all right? So if it's greater than $100 on the stock, we move the decimal 3 ticks to the left, all right? So 13 cents down to here, we can see this fits that rule. We're looking at the ones that are just out of the money, but closest to the at the money and closest to 35 days to expiration, all right? That's the rule to be able to trade this underlying with options. And the reason why is because if they're really wide, then we have to give up a lot of edge to get in and a lot of edge to get out. And that is going to really affect our ability to get in and get out easy. Think about it. If I had to give up 25 cents, if, you know, this was really wide and I had to give up 25 cents to get in and 25 cents to get out, you know, that's 50 cents of leeway, right? I mean, that's a lot of slack. Well, if it was 50 cents of leeway, it would almost take me about 10 days to, because if we look at theta, it's going to take me, if it takes 5 cents every day, that's 10 days that I'm going to need to work to get to break even, right? Because 5 cents at 5 cents a day, and I gave up 25 cents to get in and 25 cents to get out, that's a total of 50 cents. It would take me 10 days just to really make up for all of that slack that I was dealing with in the beginning. So stay away from that. We want to make sure that our bid ask is pretty tight, and that is a really good rule of thumb. So if it fits that rule, you know, you're going to hear me talking about that we're going to have something like, you know, we've got the stoplight kind of thing, right? So if it fits that rule, it makes it a green light. Sometimes we're going to get some yellow lights, right? Sometimes we'll get some yellow lights, but if we get too many yellow lights, then we aren't going to do it, all right? If we get too many yellow lights, we won't do it, all right? And if you get a red lights, we're just going to move on to something else, all right? So the idea is to try and get all of my rules fitting with a green light. If you have one or two that maybe one that's a yellow light, then that's okay. Just know that we are breaching it a little bit and maybe not going to have as great a success rates in some regards. All right, would you ever use weeklies if they are closer than 25 days to expiration than the monthlies? So for instance, GLD would be a good example of that. 35 days to expiration is the closest to it. As long as it still fits that rule of, move the decimal 3 ticks to the left and it's working out, then yes, you can, Neil. I have no problem with you doing that. Just know that the weeklies are not going to have as much participation as the monthlies, and it could mean that it would be a little bit more difficult to get out. But you can see with just 4 cents to the bid ask, these are very well participated in on a daily basis. It looks like we could just go and look at volume and open interest and see, yes, there's a lot of open interest and quite a bit of volume on any given day. So that would work if that held true with your XYZ, okay? I usually stick with the monthlies, though, is my preference. But you definitely can. All right, picking the right environment. We are doing XYZ. And when I'm saying picking the right, just keep in mind that, picking the right means we are going for a strangle. So, we could just say, the right environment, the XYZ is less than 10 cents, or, you do the decimal 3 ticks, right? The right environment would be greater than an ID percent of 50, right? So we're looking for ID percent, not IV. We're not looking at implied volatility, just IV. Okay, that's different. And we're not looking at the VXX or the VIX, all right? None of that stuff matters because every underlying is created differently, all right? Every underlying is in and of itself different. So we need to make sure that the environment is appropriate for this particular underlying. And what I mean by that is like, Tesla could be more volatile than, say, Kellogg or Kroger or something like that. The techs are going to be more volatile than maybe consumer staples or the blue chips. So we have to look at these on an individual basis. And what we do is we look over here at implied volatility, and you can see gold is very near the high for its implied volatility. But what we need for this is to find out what the high is. This is 17. Implied volatility 17 is a high. Low is 8. 17, and we'll call it 8. And then it's currently at 15. So what we do is we take the sum in the numerator and divide it by the sum in the denominator. So in the numerator, we're looking at the current minus the high, and then divide that sum by the high minus the low. All right. So in our example, we were giving 17. The current minus the high. I did that backwards. It's the current minus the low. So the current minus the low. Sorry about that, you guys. So 15. 15. Gosh, just butcher job here. So we got 15 minus the low, which we said was, what did we say it was? 8. 15 minus 8. So we take that sum and divide it by the high minus the low, which is 17 minus 8. And so we're going to have 7 divided by Eric's. Eric will show up for this webinar sometime today. 7 divided by 9. So that's going to be in the upper, I would say it would be 80 something, 80+%. But just kind of doing it in my head. We can easily look over here and just check it out because I have the code that goes in there to figure it out. But that's how we do it. The current minus the low, divide that by the high minus the low. And that's how we'll come up with it. So that's how TD Ameritrade's coming up with it as well, but they're taking it out to the, looks like the 10,000th to do that math. All right. So we want, when we're looking at this, and all of a sudden XYZ, we want to put on a strategy that's neutral bias. We've already checked the page over here to make sure it fits my rule. And now we are looking to make sure the environment is right, which is, you can see it on toss down here. Also, current IV percentile is 85%. This goes out a little bit further, obviously. But if you don't have it on your platform, you can easily do what I just did and take the current minus the low and divide that by the high minus the low. That'll give you where we are in relation to where it's normally been. Because we can look at GLD and say, all right, well, 17 is high here, right? Well, we go over and look at something like IBM, and IBM rarely gets down to 17, right? It's usually going to be probably running it around in the 20s, okay? And something like, if we looked at Tesla, the reason why you can't just look at this number over here is because, look, Tesla, the high is 111 and the low is 48. So it never ever gets as low as what we saw in gold. And the reason why we need to know why or where implied volatility is right now in relation to where it's been in the past, because just like a chart up here, we see that volatility has a tendency to stay confined to a certain range. Like, it's never going down to 10, right? So we don't have to worry about that. But what we have to think about is when it's down here at 48, what does that mean? Well, it means that volatility is really low for Tesla. And when it's up here in the 90s, we're like, okay, it's pretty darn high for Tesla, right? So when it's pretty high, that means those premiums are going to be at the highest, like GLDs up at 85. That means these premiums are at the highest levels we've seen in just about ever, at least this year, right? So that's the opportunity. When you see extremely elevated implied volatility, that's the time for premium selling strategies, okay? So when we are narrowing this down and we say, you know, the right underlying and the right environment, well, the right environment, or the environment right now, is greater than an IV percent, implied volatility percent of 50, okay? So that's when the light bulb should go off and we all of a sudden go, all right, we need to get credit spreads. We need to collect a credit when you get IV greater, because that's when premiums are at the greatest. And we saw in that chart of implied volatility that when implied volatility gets jacked up to elevated levels, you can see it comes out almost as quickly. All right. You can see gold's implied volatility is getting ready to come out also almost as quickly as it came in. So we would want to take advantage of that. And the reason why is because we were talking about theta and all of that other stuff. Well, when we look at volatility, the volatility component, or Vega, the rule for Vega is, right, for every 1% drop here, our premiums will drop by the corresponding number in Vega. All right. So we're going to be selling the premiums, and we want to see for every percentage point this 10 cents to come out, right? Or 11 cents to come out. Every day that goes by, you know, you think you're selling premium to get the theta, the thief to come and steal your premium. Well, you can see that theta every day is a lot less than 1 percentage point coming out of implied volatility. So that's what we're looking for, is when implied volatility is at near highs or at the highs for this underlying, that's the time to be selling premium, because we expect volatility to come out and the market to, or actually the markets in the options to see those premiums come out. Okay. So that's what we're looking for, is the premium to have it all, you know, premiums get pumped up when volatility jacks up. And that's what we're looking for. And then, picking the right duration. I mentioned this. We're looking for that closest to 35 days to expiration. Why 35 days to expiration? because this is, our option strategies are out of the money. We already talked about that. We're going to be selling it out of the money call and an out of the money put. So our theta is going to look a little bit different than this, all right? But all theta contracts at relatively the same rate, all right? So just to give you an idea as to why I'm talking about that 35 days to expiration being what we're looking for, because you can see out here on the curve, we don't have that theta decay. And one other thing is when we come in here, you can see a 50% drops in our premium happen between 35 days and 7 days. Now, I don't like to go inside of this area right here because we have to deal with gamma. And I don't want to deal with gamma right now. I want to stay away from it. It's probably not going to affect this strategy as much as, some option strategies that are dealing with closer to at the money calls and puts. But if our option is being tested on one side or the other, if our calls are being tested or our puts being tested, this gamma is really going to affect us. So I would try and stay away from that. We want this kind of theta contraction. Another thing to think about is when we are looking at this strategy and we get that high IV, right? I was talking about implied volatility. When IV percent is really high, jacked up, then what it does to this curve is it kind of holds it off a little bit. And as it's jacking up and down with volatility, you're going to see those premiums move. And then when that volatility all comes out, it catches up. So, we also get this kind of drop happening if we are correct on our assumption with implied volatility coming out. And that's what we want. We want that volatility to pump up those premiums. And then when theta and volatility comes out of it, we're able to capture that decreasing premium. Remember, because we're selling it, we want to sell high and buy low. And picking the right strikes. This seems pretty easy. But what we are looking, especially because I already kind of gave it away, we're looking for that 16 delta, right? So we're looking for the 16 delta here for the calls and the puts. The duration, I said, less than 35 days to expiration, right? That's what we're looking for there. The right environment is greater than an IV percent of 50%. And then the right underlying is, my rule of less than 10 cents, less than 10 cents to the bid ask, or less than the 3 decimal point move. All right. So that's what we're kind of looking for. Does that make sense to everybody so far? I haven't lost anybody, have I? Why are we picking the 1 standard deviation away? Anybody understand why? Or that 16 delta? I gave it away. I told my own joke. All right. Well, we're picking the 1 standard deviation away because if we add up all of these here, we're going to come up with very close to a 16%. And 16%, believe it or not, equals the 16 delta. Because delta is really probabilities, okay? And it tells us a lot of things. It also tells us how it changes the premium. But it's more importantly, in my mind, our probabilities here. So we add up that. We only have a 16% probability of getting hit on this side and a 16% probability of getting hit on that side, all right? So actually, because we're going to be right here. Actually, no, sorry, we are going to be right here. Eric's having trouble today. But 16%, you add up all of this and all the way out here, it'll add up to about 16%. So we're looking for the 16 deltas here and 16 delta over here. That means we have a 68.2% probability of success. All right? Because there's only a 16% chance of it landing out here and a 16% chance of landing it out here. That means that there is actually about a 64% probability is what we're going to be looking at. All right, because it's 16, 16, and then that makes the 64. So somewhere right between the 64 and the 68. is what we're looking at. All right, and knowing our exit strategy before getting into this trade, I'm going to be looking at, now I usually look at 50% of max profit. All right, that's what I'm usually looking for. If you have a little bit less risk tolerance, you can go to about 30%. And that's what we're looking for our exit strategy, right? So if I collect $1 credit when I do this strategy, I'm getting out when it's a 50-cent credit. You're never going to see this go into a debit, but 50-cent credit. All right. I mean, you will if you have to pay for it. It's going to be a debit. But when it's only at 50 cents, that's what we're looking for. Does that make sense for everybody? Another thing you can look at with this strategy, which is really important, because this is going to take into account that that curve we were talking about. Remember, we saw that curve that kind of looked like this for the days to expiration, and I was saying, 35 days is what we're looking for. Well, when there's volatility pumping into that, and maybe that curve kind of does that, well, when that volatility comes out, and I said it catches up to this curve, this normal curve, that's when we could see our strategy come in much quicker. So if you're only in this strategy for 5 days, especially if you have lower risk tolerances or you're very new to trading this strategy, 5 days less. If you're in this for less than 5 days, then look for like 15% of max profit. You're in for less than 10 days and you're at 25%. I would seriously consider it because you've beaten the probabilities, you guys. It's not just a normal day at the park where we're just waiting for that theta. We've left our doors unlocked. We're hoping theta comes in and steals our premium. Well, all of a sudden volatility left the room and all that air came out of that balloon. That's another way to think about it. A balloon, it's at a normal thing would just be kind of like 3 puffs in it. Well, you get 10 puffs in there, and that's where volatility has expanded that curve out to. Well, now if you're seeing this kind of action, then that means somebody let go of the balloon and all that volatility came out. That would be the time to jump on this, all right? So less than 15 days, you're looking at 35 days. So this is another way to kind of help you think about when you're going for that exit strategy, especially if you have a lower risk tolerance. I'm generally going to shoot for that 50% of max profit on it. On the losing side, I will usually do 2 to 3 times the credit received. I like to play out the probabilities. Again, if you are a lower risk tolerance individual or newer to options trading, go with the 2 times the credit received. So if it was $1, we had collected $1 credit for this and it was trading at $2, then, that would be where you got out. I'm usually going to wait till it goes to about 3 times that. So at about $3 is where I'm going to look to get out of this because I'm looking at the probabilities. I know that I'm probably going to be tested on one side or the other during the course of this strategy. I know the market's probably going to go up there and give me a kiss just to let me know that it's there. Almost never will you see it just trade sideways and never test you. So I'm going to go for a little bit more of that and play out the probabilities, all right? All right, so our max profit. Our max profit is that premium received. Everybody's commission is different, so we don't know what that is, but it's that premium you received on this. Your max loss on this is unlimited, all right? Because the underlying can go to 0. So you can, or go to infinity, right? So your max loss is unlimited. Yes, if it goes to 0, we don't have to worry about it too much. But we do need to know 2 break-evens. And the break-evens is when the underlying short call plus the premium received, all right? So if we had the 100 calls on and we collected $1, our break-even would be when it's at 101. The underlying XYZ is at 101 at expiration. And to the downside, let's just say we did the 90 calls and we collected that $1, it would be our break-even is at 89. All right. Pretty easy. Anytime you collect the credit, it widens your break-even area. All right. All right. So without further ado and without further boring you guys, hopefully, let's pull up the platform. And this is usually where I throw it out to you guys. Give me some examples of stocks that you think you have a neutral bias in, and then we'll go through it and see if that works with this strategy. First one I saw was, I think, Micron. All right, so Micron, we got a neutral bias. They just came out with earnings. They missed on them, or they beat on them. So you already kind of lost this volatility, and I wouldn't expect it to go a whole lot further. You know, if you expected volatility to come out for the rest of the month, then, you know, that would be that yellow light, right? You're breaking the implied volatility percent. And the reason why I have that rule is because when volatility is elevated, we expect it to come out. Well, if you are expecting volatility to come out and you're breaking my implied volatility percent rule, just know everything else has got to be green lights. You're going to have to expect volatility to come out further with this than before, all right? So I'm going to pass on this. The next one we got was AMD. Keep wanting to hit my... all right, so AMD, let's check it out. Go 25 days to expiration. So we're going to go see if this is the right underlying. It's a $30 stock, so we're less than 10 cents wide to the bid offer. Yes, so that checks it off. We can check out what implied volatility percent is. It's 27. So it's below that implied volatility percent of 50. We also don't want to do this ahead of earnings. Like if I was in this month right here and we were looking at earnings or making sure there was no earnings in it, well, you know, if there's an earnings right here, don't do this strategy that many days in advance. Say it's on, the earnings are on the 17th, let's say. All right. Inside of this option expiration, we wouldn't want to set it up that long in advance. All right. I have specific rules for trading earnings events with this type of strategy and other strategies, not this far in advance. Okay. Because we would expect volatility to expand heading into an earnings event, all right? But right now, AMD doesn't have the volatility, and that's one of those ones that's going to be the real, it's the key to this strategy on that, all right? 27 is just a little too low. So somebody else threw out CMG. Let's check out Chipotle. So Chipotle, we look at it, $700 stock, move the decimal 3 ticks to the left during open market operations, 70 cents to the bid ask. These are $1 wide right now, which breaks that rule. If you're used to trading a stock like this, you know, I know CMG meets this rule generally speaking during open market operations with the move the 3 ticks to the left, and we should be at 72, 73 cents, right? Somewhere in there, and we're at a little better than $1 down here. But this is during open market operations for this rule, and we are after the close, and most people, you know, CXL is what we say on the floor when we wanted to cancel our orders. So a lot of orders are being canceled in there, so it's probably not as tight after hours as it is during the open market hours. I'm going to assume that they have this tighter during open market operations. Check to make sure their earnings are after this binary event is afterwards. A binary event is just something like an earnings. It's a known event that's going to affect volatility. So we know we are outside of that. We don't have to worry about it. We expect volatility to come in a little bit, at least for this expiration. So we're going to look for the 16 delta. We're trading 724, so 725 is at the market. But we're just going to drop down and look for the one that's closest to the 16 delta. Now, I'm usually one that will default out a little bit, if I'm not too sure. And sometimes if I want more premium, I'll roll it in just a little bit. So I'm kind of either way. It's up to you to decide if your risk parameters are, you don't have very strong risk parameters and you're a little bit newer to options trading, then maybe roll it out just a little bit. All right, so then 16 delta here, of course, they're giving it to us. That's pretty simple. Now we look at our credit for our break even, and I would probably look first at this and be like, okay, I think that Chipotle is going to stay within this range. Are you going to give it to me? Like this range kind of thing, and make sure that my strategy kind of falls outside of there, at least pretty closely, right? So that would have been something I probably would have looked at too when I'm building out those strikes. But the 16 delta is the one we're usually looking for, and that will nail it. So break evens on this, right? Break even to the upside is 7.55. Okay, right? Because we add this credit into the strike, and to the downside, we subtract that $7.50 on there. So we are going to be looking at $6.77.5, right? Did I do that right? 77.5, 8. Yeah, so 77.5 cents. Did I do that right? 60? No. So I got to subtract it. 67.5. Right? 7, 8, 7. Yeah. So those are your two break evens on that. I'm going to do all the math wrong just because I'm trying to make sure you guys are paying attention. No, that is not true. I'm not going to do that. I'm not trying to do that. I am keeping you on your toes. All right. So Nokia, it's probably got implied volatility percent somewhere in there. I know I don't have them in there. 27, it's a little low. And it's going to be really, really hard to do a strangle around something with this low of a pricing. So I would just stay away from this. I'd walk away. All right. Sorry, Jim. All right. Stan's got Apple. All right. So Apple, we're going to look at it, make sure there's no earnings event lying in there. So we're good. Implied volatility percent we can check out is 30. It's a little low. You would have to expect volatility to come out. One thing to note is $100 or $200 stock, 3 ticks left, 20 cents. We can see Apple beats my rule on less than 10 cents usually. So that would have fit, but it's not going to fit on the rule for the implied volatility percent. All right. THX, I've never even heard of that. Is that Houston? I don't even have options for it. Sorry, D. All right, so let's look at, we can look at IBM. IBM, 62 IV percent, that works. It's trading right there at the point of control, which usually means that, oh, that was, thanks. Sorry. Anyway, it's right there at the point of control. So you guys know this would be something I would be very interested in when they come get right close to this point of control. It acts as like a magnet and wants to hold it there. So this is on the market profile that I'm talking about over here on the side. And this big line right here is the point of control. It's where the most time and volume has been spent. So it's like the comfort zone. It's the comfort food when we get in there. So I'm going to look for something to kind of stay within like that range for IBM. I'm assuming they don't have earnings. They might have an earning right there, but let's pretend they don't if they do. So 20, we already did the bid to ask, didn't we? So we're looking at 14 cents. Want to give me 14? 14 cents to the bid ask down here. You can see they're about 10 cents. Some of them are looking like 20 cents, but this, again, is during open market operations. It usually will fit that rule. The other thing we need to look at is we have high implied volatility percent. So this is how I would work through it when I came up with my neutral assumption. Like I kind of drew on the chart, said, okay, well, I think it's going to stay within this range. I think it's going to be neutral. It's right there at the point of control. So now I need to find what would be a good option strategy for it. Well, I know it is a good underlying. I see it's got implied volatility percent above 50. I expect that volatility to come out. We're right within my 35 days to expiration. We got 22, so that's inside of that wheelhouse of where we're getting that big theta contraction. If we get volatility coming out, that'd be even better. So then we go and look at the 16 delta. Start off over here at the put. I'm going to roll it in a little bit for this one. And then 16 delta here is the 148. So 148 to 122 is my range. You know, we added in to the upside. We can see it's going to be 149.83, and to the downside, we're going to be at 126.17. So we've got pretty good range there. 126.17. I mean, that's putting me below the value area. And on the upside, what was my range on the upside? 48 to 50. So to 50 to the upside. So that's a pretty good range. I mean, that's bigger than the range that we've seen happening for quite some time. What did I say? The 120 something. So down here, I mean, you can see for the better part of the last year, we've stayed within that. So very high probability strategy, especially when you get those high premiums. When you look at a spread to be less than 10 cents, are you looking at the 16 deltas you trade, or are you looking at the at the monies? I am looking for the ones that are closest to just out of the money. All right. And usually if it's just out of the money, these are going to have participation in them also. Like if I came in and it fit my rule inside of here, but I come out here and look, it's a little bit wider. Of course, it is aftermarket operation, aftermarket right now, and we're looking at this during open market operations. Usually if there's a lot of eyeballs and it's fitting that rule here, and I come in and I just say, you know what? I'm trying to sell this, right? So, you know, I come in and offer it at 81 cents. Well, usually because there's so many eyeballs in it, especially because it's IBM and stuff like that, somebody might come in and go, you know what? I'll be a 70-cent bid. All right. So then all of a sudden we start tightening up the market. All right. Or maybe he'll go straight into, I'm being realistic, it's probably 73 cents, you know, and then I go down to 80 and we start working it out. Right. And another thing I haven't mentioned in a couple of these, and I know there's a lot of new faces last couple of times, never put especially on naked strategies like this or whatever, they're going to try and make you go middle market. Because believe it or not, Toss does not really care where you get filled. All right? Big sad face. They don't care. We used to say on the floor, it's fill them and bill them. All right? Get it done. Get it out of here. So whenever you go in here and, you know, if you ever looked at selling a strategy, look, they're making me sell it at the bid. Don't ever get caught in doing that. And if I do this, then they're going to kind of try and throw me mid-market, maybe a little bit lower. I always go in a little bit higher to where I think I'm probably not going to get filled here. Put it in, cancel, replace. Now, I'm not saying wait 5-10 minutes for the market to work out. I'm saying hit enter, confirm, send. By the time you go over to your monitor tab, click on this, adjust the prices, you know, click down a couple of times, confirm and send, confirm and send. Then that would be enough time for you to have the algos, because there's algos in here also. Like, you know, there's people that are doing spreads where it's like, it's not just the 37.36. It's like the 37.40, and then somebody else has got a spread in there. And, so the algo sees better prices in there that it can auto leg out. All right. So once it sees me come in and say I offer, I'm looking at this 16 delta, I come in and offer it at, $1 and, let's say 14 cents. I better it just a little bit better. Well, there might be a bid $1.14 I didn't see. Okay, because there's an algo saying I'm bidding $1.14 because I'm leaning on something else that's leaning on something else. It could be confusing, but spreads can lean on spreads. And that's actually how I made my name on the floor, was being able to put about 5-6 different spreads in my head and know where each underlying bid offer was, even though nobody else could see it. Because I knew that if I leaned on this spread to lean on that leg, and then used that leg to lean on a leg that was leaning on a leg. It's confusing, but yes, the algos see better bids and offers than we can see. They can't show you a bid or offer if it's leaning on a lean. All right. So, Banu, I'll show you how to do it in an IRA here in a minute. Thank you for reminding me. All right. And Eileen, you're asking, what is the put strike? We're just looking at a 16 delta. So with this one, I rolled it up. We're defaulting to the 16 delta. If we don't have that 16 delta, I'm looking to the closest one. All right. If you're a little worried about the risk parameters on this one, I would suggest you to go roll it out. You would have done the 125s instead of the 128s, which I decided to roll in on. All right. Does that make sense? Eileen? All right, so Banu, while we're at it, let's just do it. All right, so let's just say we picked these strikes. We're really happy with this one. You wanted to do it in an IRA. What I suggest for an IRA, just all this does, it does not lower the risk parameters on this strategy, and probably won't even limit your margin in some cases. In an IRA, it probably will, because they try and get it cash secured and everything. But the thing I would do here is, then you took that 16 delta. I go out to the first option I can buy for a nickel or as close to it. This offer is a nickel. If it was like 6 cents at 7 cents, that I would assume I'd be able to get the nickel contract. So I would buy that one, go down here, and I'm just looking, where can I buy one for a nickel? And I'm going to do that. All right. Oops. I'm going to buy that one. That makes it IRA appropriate. Now, it is not what I would suggest to look at this as a defined risk strategy and play out the probabilities, okay? We're still going to look at this as, 2 times the credit received is where I'm getting out, or something along those lines. That nickel doesn't do anything but, snub your nose at the rule makers, because they don't really understand what they're making rules about when they're talking about options. Really, it comes down to they don't understand options, so they're making rules about options, saying that they're inappropriate for some people, which is ridiculous. The probabilities of trading options are much better than the probabilities of trading anything out there. Find me something where you can find better probabilities than trading options, and I will debate you all day long. All right, so IBM is a good one. And one that I actually, so that was a good one. I might actually look at that one tomorrow, John. So IBM is the one that we just looked at. And then the one that I was going to suggest we look at was United Airlines. It had high implied volatility, but you can see it was just slightly above IB this morning. It came out today. But what I love about this is we can look at this chart, right? Oh my gosh. UAL stays in between this area all the time. We got the point of control right there. It's very close to it. Gosh, if I could sell up here and sell out here, that would be great, because almost all year it stayed within that range, right? At least the low we don't have to worry about too much, especially if they don't have earnings. We're assuming they don't have earnings right there. So United Airlines, I'm going to just say I'm expecting the volatility to come out. It was implied volatility of 50 earlier today, and it's very close. So I'm looking at it like a yellow light. All right, it's an $80 stock, so less than 10 cents wide to the bid ask. Even after hours, it's fitting that rule. All right, so now I'm going to bend on the implied volatility percent. But now we're looking at the 16 delta. I'm going to roll it out just a little bit. We go to the 15 there, the 16 there, delta. So $1 credit to the upside, so 95 to the upside. I'm going to just say 78 to the downside. So 95 to the upside puts me like, whoops, it was 95, wasn't it? What were my strikes again? 95 to the upside and 78 to the downside. 95 to the upside. So 95 to the upside and, oh, I keep forgetting to do my pen. And I'm doing it all. I'm not playing the lottery today. All right, so 95 to the upside and like 79-ish to the downside. So that's a pretty big swath, you know, for my probabilities. And when you're looking at this chart, yeah, United Airlines been all over the place, but it stayed within this range, right? Very high probability strategy. So boom, that would be a good one also. That was the one I betted earlier today, and I was just like watching volatility come out of it. But another good one, pretty simple though. Look for the 16 delta. Check out your charts. I mean, I am above that resistance. I got a couple of supports on the way down. I would be very happy with that. Does that make sense? We have to do this extra nickel trade in Canada. You're right. You're right. I think you do. Can you explain briefly what it means to lean on a leg? Yeah, so, all right. Actually, let me do that, Neil, here in a minute. Let me finish up real quick, and then I will do the lean on a lane, all right? But right now, this is our deal for the Pro Trader Strategies, option strategy number 4. If you guys have gotten any emails about Steve Primo, he has a great charting system where it gives signals. I don't give signals. I will tell you guys what my assumption is and stuff, but he gives actual signals. I usually look at economic, geopolitical, earnings, all of that other stuff to get my directional assumption. His is specifically on technical analysis, which is great. And I've done research to come up with the best option strategies for his trading strategy number 4. And this one, we are offering it only for the first 50 people, so you guys are going to need to take advantage of it. This is the link for it. If you're watching this on tape delay, you're going to have to pause your video, type that in. If you guys are watching this right now, you should take advantage of it over there in the chat window. You can just click on the hot link there. But this is what it all composes of, everything in this. So you get all kinds of strategies, about 10 hours worth of stuff, plus bonus material on the different things that Delta will tell you about probabilities. We've got that going on in there. Why? All right. You don't want to work for me. So we have that working out, all of these videos, and you get Steve Primo's charting system for strategy number 4. Like I said, it will tell you this is a buy signal, this is a sell signal, and then you basically can take all of this and implement it in and around that strategy for a high probability trade. You know, anytime anybody is giving you indicators, if you have an indicator service outside of Steve Primo, Steve Primo's is great. But if you're using chart analysis or technical analysis, I have strategies for that assumption, right? That's what we're going through here. And I built it out specifically for Steve Primo's. In this one, you could implement it in and around your charting system as well. But these are the best for directional assumptions around when you get a signal, okay? You don't have to worry about a lot of the things with following my rules in and around this, okay? So take advantage of that. Like I said, it's in the chat window there. Or if you're watching it on tape delay, you'll have to pause it and punch this into your URL. But I just want to thank you guys all for taking advantage of this opportunity. In later webinars, I'm going to be drilling down on different option components, when and where I find those, especially in those daily market commentaries, you guys. If you guys, I send those out every day. Talk about all the trades I do, when and where I find them appropriate, what strategy I'm putting on, when I'm going to take it off, all of that stuff. Even the losers. I talk about the losers throughout in these daily market commentaries because those are the ones that are most concerning to us, right? And those are the ones we need to work on being mechanical with, like adding different option strategies to them, playing around with them, making sure that we're increasing our success rate. All right. I just want to thank you guys all. Here's the number 310-598-6677 or email us at trading@protraderstrategies.com. All right. So let's go. Neil, this is why I kind of paused on this. I'll let everybody else pause on this as well. If you guys want to stick around for this, you can check it out. All right. So let's look at pricing. So let's just say that I have pricing, and I'm just going to go like this with July, August, September, October, November. And those are symbols we used to use on the floor. So let's just say July is 80 bid at 85. And let's say August is, let's just say 75 bid at 85. And September is, actually, let's change this. Let's make that 80. I want to make the front ones tighter because usually you go further out and it's a little wider. So I'm going to say this is 70 bid at say 78. Okay, so this is your quotes, all right? So this is your quotes. These are the outrights. You know, you can see this is 100 up or whatever, right? So this is what you're getting on the screen. And then this we could say is like 65 bid at 75. So they're starting to get really wide, all right? So now we look at a spread. We got July, August spread, all right? So July, August spread is right now 0 bid at 10, right? If you just do the legs across, if I was doing a spread, I'm buying this one and selling this one, right? If I'm buying this spread, I'm buying this one, selling that one. So I'm basically even bid at 10. Well, what happens if July, August spread is 5 bid at 7, all right? And then August set is, let's just say right now, you can see the legs it's 3 bid at 10. But now we can see that it is 6 bid at 9, all right? So the spreads mean something because now if I was going to leg the July-August spread, I'm 5 bid, right? Well, if I'm 5 bid the July-August spread, I'm 80 bid to sell those 75. So I'm leaning on this 100 lot. Does that make sense? If I'm legging the 5 bid here, I'm 5 bid July to sell the August, right? And vice versa, if I'm selling it, I can't sell 85s because I got to buy the 80s. So I can't leg the offer side, but I would definitely be 80 bid here. Now we look over here at the August set. Now, I'm looking at it like if I'm 6 bid, well, if I buy the August 85s to sell those 70s, that's 5. I'm 6 bid. So I'm actually 76 bid here. I'm 6 bid to sell those. All right. So, you know, now this guy's 81 bid to sell those. But this 6 bid is leaning on the 70 bid, right? Well, if Sep-Ak is 5 bid at whatever, 10. So Sep-Ak, I'm 70 bid leaning on the 65 bid, right? So this, I'm 6 bid leaning on the 70 bid because I know this is 65 bid. all right? The SEPOC, and you don't see all of these spreads. So you don't see that it all started out here on this October because it's bid for 100. 65 bid October. Well, I'm 70 bid October. I bettered it because I am leaning on this order. All right. Well, then that means since I'm 6 bid here, I'm 6 bid leaning on this order. But this order is leaning on this one, so this 6 bid doesn't show up. Does that make sense? Neil, did you follow me there? So the computer will not show this as a 6 bid. But if I came in and offered it at 76, I'm going to get filled. The computer will go, all right, well, I'll buy your 6s and sell those 70s real quick. And then the 70s hit the 65s and then it's all gone. All right. So what happens is you'll look for the premium way out here and then all of the spreads, because this 70 bid is leaning on the 65s. Well, it's just me. It's not an outright market. Now, the platform may show this 70 bid because it's leaning on an outright. It knows that outright's not going anywhere. But this market is going to show a 75 bid because it's leaning on a phantom. It won't do that. So I will say I'm 6 bid. Or in July, I'll be 81 bid. But this on the market, on the screen is going to show an 80 bid. But I know I'm 81 bid, and we used to call it in the weeds or leaning. I'm leaning on the leg because I'm 81 bid to sell that, but this is only 60 or 76 bid to lean on that, and then it leans on that. So what happens is if I sell 81, if 81s trade here, you're going to see 76s trade. You're going to see 70s trade and 65s trade all at once because the algos are going to auto leg all of that stuff. Okay? So that's what I'm saying, a lean on a lean. You know, there might be better bids and offers in there that you aren't seeing because of this scenario. There's spreads in the market and there's outrights in the market. And the spreads will lean on the outrights to leg your spread. Okay? And that's why sometimes you'll put in a bid or an offer mid-market and you get hit. And you're like, oh my God, why did I just get hit? Well, because there's an algo in there leaning on some spreads. And they're going to auto leg it out. Okay, but it won't happen. It won't show you unless it can match all of it up. All right. But that's how I made a lot of money on the floor, is that I could put all these spreads in my head and know where the bids offers were. And, you know, the outrights could very well be wider than where the market is. All right. So that's another reason why I put